Prep Agent Finance. Which of the following statements about housing loans with federal government support is false? The federal government supplies funds to the lending agency. FHA may insure mortgages for either apartment house projects or single-family residences. The federal government insures the lending agency against losses. Federal Veterans Affairs loan guarantees may be used for condominium financing. And it's false that the federal government supplies funds to the lending agency. The federal government supports many aspects of home loans to make it easier for citizens to purchase homes. For example, the FHA insures lenders of federally backed loans against losses for mortgages on single-family residences and multifamily properties, and VA-backed loans may be used to purchase condominiums. The federal government does not, however, supply funds directly to lending agencies. Note, this question asks which of the following statements is false, and it's false that the federal government supplies funds to the lending agency. Who is the recipient of the mortgage insurance payment on an FHA-insured loan? Mortgage or FHA? The lending institution, state real estate organization. What is the FHA? An FHA loan is a mortgage that's insured by the Federal Housing Administration, FHA. However, borrowers must pay mortgage insurance premiums, which protects the lender if a borrower defaults. Borrowers can qualify for an FHA loan with a down payment as little as 3.5% for a credit score of 580 or higher. Which of the following does not directly affect the level and movement of mortgage interest rates? The supply of funds, the inflation rate, the rate of unemployment, the demand for funds. What is the rate of unemployment? Unemployment rates do not directly affect the level and movement of interest rates, but can impact rates indirectly depending on how the unemployment rate is affecting the market. The lender is required, under TRID, to provide a detailed loan estimate statement at the time of loan application or within 3 business days to the buyer and seller. The buyer. Neither the buyer nor the seller. The seller. What is the buyer? When a home buyer applies for a home loan, the TILA, RESPA Integrated Disclosure Rule requires the lender to provide a loan estimate to the buyer within 3 days of receipt of the loan application, and all revisions have to be delivered at least 7 days before closing. The loan estimate details the loan terms, mortgage payments, costs at closing, and other costs and fees related to the loan, many of which cannot change. A mortgage is usually accompanied by a conditional sales contract, a title policy, a deed, a promissory note. What is a promissory note? A promissory note, sometimes referred to as a note payable, is a legal instrument, more particularly, a financial instrument and a debt instrument, in which one party, the maker or issuer, promises in writing to pay a determinate sum of money to the other, the payee, either at a fixed or determinable future time. The seller under a land contract is called the grantor, the vendor, the grantee, the vendee. What is the vendor? Land contracts are also known as installment contracts. In this type of arrangement, the buyer occupies the property, but the title is held in the name of the seller until some future point in time, often when the last payment is made. When Jones purchased Brown's property on an installment sale, he assumed an existing loan, which exceeded Brown's basis in the property. The amount of the assumed loan over Brown's basis will be treated as part of the down payment whether cash was received or not. Added to Brown's basis. Deducted from Brown's basis. Treated as part of the sales price. What is treated as part of the down payment whether cash was received or not? In an installment sale, the amount of an assumed loan which exceeds the seller's cost basis is treated as part of the down payment and is taxable in the year of the sale. The Federal Reserve Board increases cash reserve requirements in order to sell bonds, raise taxes, decrease loan activity, increase loan activity. What is decrease loan activity? The Federal Reserve Board can increase cash reserve requirements to decrease loan activity, which results in an overall reduction to the supply of available money. 2. Compugram financing. Net income can be defined as total of all income incorrect, effective gross income, potential gross income, income after expenses correct. What is income after expenses? Question rationale. Net income is gross income minus a figure for vacancy, collection and expenses. A partially amortized note which reduces part of the principal by the time the final payment is due is often called a wraparound mortgage. A fully amortized loan. A conventional loan. Incorrect. Balloon payment, balloon note. Correct. What is balloon payment or balloon note? Question rationale. A balloon payment, balloon note is partly amortized and then a lump sum payment of the principal is due at the end of the loan. A fully amortized loan is a complete reduction of principal each month with steady payments of interest and principal and results in the loan being paid in full. RESPA requirements would not apply in which of the following situations? When property is purchased with a federally related mortgage loan. When the property mortgage is guaranteed by VA. Incorrect. When the property mortgage is insured by FHA. To a conventional loan that would not be sold on secondary mortgage markets. Correct. What is to a conventional loan that would not be sold on secondary mortgage markets? Question rationale. RESPA requirements apply when property is financed by a federally related mortgage loan. Federally related loans means loans made by banks, savings and loan associations or other lenders whose deposits are insured by federal agencies. It also includes loans insured by the FHA and guaranteed by the VA and loans administered by HUD. Further covered is any loan intended to be sold by lenders to Fannie Mae, Ginnie Mae or Freddie Mac. An investor decides to take money out of a savings account and invest it in corporate securities in order to obtain a higher yield on his investment. This movement of money is known as dedication. Discrimination. Debt service. Incorrect. Disintermediation. Correct. What is disintermediation? Question rationale. The movement of money out of a savings account into a higher yield investment such as corporate and government instruments is called disintermediation. Debt service is the amount of money paid in regular intervals to reduce the balance owed on a debt. 2. Prepayment financing. A veteran purchases a home under the CalVet program. In such transactions, who holds title? California VA. Veteran, who in turn assigns it to the California Department of Veterans Affairs. Purchasing veteran. Beneficiary. What is California VA? Under the CalVet program, funded through bond sales, the Department of Veterans Affairs pays cash to the seller and receives title in return. The department then sells the property to the approved veteran using a land sales contract. Who is the largest purchaser in the secondary market? FHA. Fannie Mae. Freddie Mac. Ginnie Mae. What is Fannie Mae? Fannie Mae stands for the Federal National Mortgage Association, FNMA. It was established by the National Housing Act specifically to start the secondary mortgage market, thus attracting more investors and funds to help support home ownership. If a single parent is applying for a real estate loan, when would the fact have to be revealed that part of the parent's income is from child support? If more than 50% of the parent's income is from non-wage sources. If the parent was relying on the income for repayment of the loan, this type of income never needs to be disclosed. It would be a violation of ECA. When applying for a VA or FHA loan, if the parent's income is less than $25,000, what is, if the parent was relying on the income for repayment of the loan? Income of any type, whether alimony, child support, freelance work or a second job, only needs to be disclosed if the applicant is relying on it to qualify for the loan. A trustee's sale is initiated by the court, the trustee, the bank, the trustor. What is the trustee? A trustee sale is a sale by a property in foreclosure due to default in the loan made from the lender, who holds a trustee deed on the property. A standardized term for expressing the true annual cost of borrowing is expressed as the Regulations APR. RESPA ECA. What is April? APR stands for annual percentage rate and expresses the true cost of the loan by factoring fees such as points, recording fees, appraisal fees and such into the interest rate. For example, a mortgage that showed an interest rate of 4.85% on the promissory note might have an APR of 5% when associated costs are factored in. A form of public notice filed against certain lands, stating that a court action has been instituted, is known as a judgment, an attachment, a lis pendens, a construction lien. What is a lis pendens? A lis pendens, Latin for lawsuit pending, is a written notice that a lawsuit has been filed concerning real estate, involving either the title to the property or a claimed ownership interest in it. The basic protection of a lender on a purchase money second trust deed would be: amount of second trust deed, equity of the borrower, credit rating of the borrower's ability to repay. What is equity of the borrower? Lender's basic protection is the equity of the borrower. First liens which take priority over all other liens are mortgages, construction liens, judgments, tax liens. What is tax liens? First liens which take priority over all other liens are tax liens. If advertised a loan, which of the following would violate truth in lending, TILA, laws? Easy financing terms. FHA financing available. Assumable loan. No down payment required. What is no down payment required? No down payment required triggers the truth in lending disclosures because it is a specific statement about only one aspect of the financing. Easy terms does not trigger the regulation because it's non-specific. Lenders know that the lower the loan-to-value ratio, the higher the equity appraised value amount loaned probability of default. What is equity? Loan-to-value ratio is a ratio of the percentage of the appraised value of a property that a lender will loan. The lower the ratio, the higher the equity. Who provides funds for Department of Veterans Affairs, DVA, loans? HUD Freddie Mac. The secondary mortgage market. Approved lenders. What is approved lenders? A VA loan is a mortgage loan in the United States guaranteed by the United States Department of Veterans Affairs, VA. The basic intention of the VA Home Loan Program is to supply home financing to eligible veterans and to help veterans purchase properties with no down payment. Insurance for a mortgage loan may be provided by FHA or private mortgage insurer GNMA, Ginnie Mae, VAFNMA, Fannie Mae. What is FHA or private mortgage insurer? Federal Housing Administration, FHA, insures lenders against loss in the event of a default. FHA loan might approve a loan to buy 1-4 units of residential property to be used for rental purposes. To get an FHA loan, you go to institutions that are authorized to deal with the FHA. There is no FHA office. Private insurers can insure loans when the borrower does not qualify for the FHA loan. Why would a beneficiary have an appraisal on the property? To make sure the buyer did not pay too much to determine the value of the property, to protect the buyer from fraud, to assure the property value is sufficient to cover the loan. To assure the property value is sufficient to cover the loan. Appraisals are third-party valuations of a property based on a wide range of variables. The beneficiary, the lenders, generally insist on this independent assessment to make sure the value of the property is at least sufficient to pay off the loan amount in case of default.